1 year ago, I called ASML one of the most undervalued companies in Europe. Since then, the stock has climbed more than 140%. And that rally has completely changed the investment case. A year ago, ASML traded below its historical valuation. Today, it's trading close to the richest forward earnings multiple it's carried in over the past decade. The company didn't suddenly become twice as good. The stock simply became much more expensive. So today's question isn't whether ASML is an incredible business. I think that's already been proven. The real question is this: has the stock run too far, or is there still upside left? Let's find out using my 5 key factor framework. If there's one factor that determines ASML's long-term success, it's the moat. Morningstar assigns ASML a wide economic moat, and it's easy to understand why. The first reason is technological leadership. ASML remains the only company in the world capable of producing EUV lithography machines, the technology required to manufacture the most advanced semiconductor chips. Replicating that technology isn't just a matter of spending more money, it requires decades of accumulated engineering expertise and one of the most complex supplier networks ever assembled. That's why, despite billions invested by competitors, ASML still stands alone. But technology is only half the story. Building one of the world's most advanced chip factories costs roughly $20 to $24 billion, with billions invested in lithography equipment alone. Once those production lines are designed around ASML's machines, switching suppliers isn't simply expensive, it would mean redesigning an entire manufacturing process. That creates enormous switching costs. And the relationship doesn't end after the initial sale. ASML expects its newest EUV machines to generate more than 150% of their original selling price through servicing, maintenance and software over their lifetime. You can also see ASML's strategic importance by looking at where demand comes from. China generated roughly 9.5 billion euros in revenue during 2025, followed by Taiwan at 8.3 billion and South Korea at 8.2 billion. Together, these markets represent the center of global semiconductor manufacturing. The trend over the last decade tells an equally compelling story. China has been ASML's fastest growing market, while Taiwan and South Korea have continued to deliver exceptional growth as companies like TSMC, Samsung and SK Hynix invest heavily in next-generation chip manufacturing and advanced memory capacity. The biggest uncertainty, however, isn't technology, it's geopolitics. China may be ASML's largest market today, but tighter export restrictions could limit what the company is allowed to sell there in the future. Every chart and every number you've seen in this video comes directly from Fiscal AI, the platform I use for every stock analysis on this channel. If you'd like to analyze companies using the same institutional quality data, you can get 15% off using the link in the description. Now you think a total monopoly would be the most profitable company in its peer group, right? Well, when we look at the actual returns on capital, the numbers tell a surprising story. ASML generated a 24.8% return on invested capital last year. That's an outstanding number and one that has steadily improved over the past decade, although it has flattened slightly in recent years. Now compare that with its peers. Applied Materials generated 29.4%, Lam Research Corporation almost 48%, and KLA Corporation roughly 39%. On this metric alone, ASML actually ranks last. But that doesn't necessarily make it a weaker business. Maintaining leadership in EUV requires enormous ongoing investments in research, manufacturing capacity and innovation. Those investments weigh on today's returns while protecting tomorrow's competitive advantage. Return on equity paints a similarly impressive picture. ASML generated a 43.3% return on equity. Now on to peers. Applied Materials came in at 35.5%, Lam Research reached 58.2% and KLA posted an astonishing 100.8%. Overall, profitability remains exceptional across the semiconductor equipment industry. Great businesses still need to grow. Fortunately, ASML has delivered. Over the past decade, revenue compounded at 18.9% annually, net income grew even faster at 22.2%. And thanks to continued share repurchases, earnings per share increased by an impressive 24.5% annually. ASML repurchased roughly 6 billion euros worth of shares during 2025. Compared with its closest peers, ASML sits almost exactly in the middle of the pack. It has delivered exceptional earnings growth over the past decade, but it hasn't dramatically outperformed or underperformed the rest of the semiconductor equipment industry. Looking ahead, analysts expect ASML to grow earnings per share by roughly 26.7% annually through 2028. A slight acceleration from its historical average. Applied Materials and Lam Research are expected to accelerate even faster, while KLA is forecast to continue growing at roughly its historical pace. The bigger story isn't that ASML is slowing down, it's that other semiconductor equipment companies are expected to accelerate faster. For financial strength, there's very little to worry about here. ASML holds 13.3 billion euros in cash against just 4.4 billion euros in total debt. The business also generated roughly 12.3 billion euros in free cash flow during 2025. That results in a free cash flow to total debt ratio of almost 280%, where 10% is the bare minimum. This isn't just a healthy balance sheet, it's a fortress. More importantly, it gives ASML the financial flexibility to keep investing through industry downturns, while weaker competitors are forced to slow down. Now we arrive at the one factor that's changed the most since my last video. Valuation. ASML currently trades at 44.6 times forward earnings. That's close to the highest multiple investors have been willing to pay over the past decade. Historically, the median has been closer to 30 times, with the stock occasionally falling as low as 18 times during weaker semiconductor cycles. Compared with peers, however, ASML isn't particularly unusual. Applied Materials trades around 38.8 times, Lam Research around 44 times, and KLA roughly 45 times. So perhaps we're asking the wrong question. Instead of asking whether ASML is expensive, we should ask whether it's expensive relative to its growth. That's where the price to earnings growth ratio becomes useful. ASML trades at a PEG ratio of roughly 2, Lam Research is almost identical, Applied Materials sits at 2.3, and KLA comes at 2.6. Using my framework, anything above 1.5 suggests investors are paying a premium for future growth. Every company in this group clears that hurdle. This isn't really an ASML's expensive story. It's a story about an entire semiconductor equipment industry that's being priced for an exceptionally strong future. Now let's put everything together through our 5 key factors. ASML's competitive position remains one of the strongest you'll find anywhere in the market. Its returns on capital are strong. Growth continues to be impressive, even if some peers are expected to grow slightly faster over the next few years. And the balance sheet is as strong as they come. The only real question is valuation. If I didn't already own ASML today, would I be rushing to buy it that close to one of the richest valuations in the past decade? Probably not. Would I sell one of the highest quality businesses ever created simply because it's expensive? Also no. Sometimes the hardest investment decision isn't buying or selling, it's simply waiting for a better opportunity. Because if history has taught us anything, it's that even the best businesses occasionally go on sale. And when they do, those opportunities rarely last very long. If you enjoyed this analysis, don't forget to like and subscribe, and let me know in the comments which company you'd like me to analyze next.